Hi guys, today I would like us to go through one of the most important, if not the most important concepts of ICT, and that is dealing ranges and choosing the right PD arrays to trade from. So kindly spare me a few moments of your time and let's go through together. Now, when you open a new chart, identifying the market trend is the first thing to look out for and less difficult to identify in most cases. The next thing after that is marking out your dealing range to trade from, which is a bit confusing than the previous. Therefore, to identify a dealing range, your concentration has to be on the range that has currently taken buy side and sell side liquidity. Now, when it comes to choosing your PD arrays, in a bullish market, we look out for key levels or points of interest within the discount zone of the dealing range. Similarly, we would have to consider key levels that reside within the premium zone of the dealing range when dealing with a bearish market. Now, personally, I use the FIB retracement tool to mark out my premium and then discount levels of the dealing range. So those of you who would also like to do same, this is my settings. You can also copy and apply them as such. Now let's come to a bullish illustration of a dealing range. Now for time factor, I will not be going through the bearish scenario since the reverse of whatever you're going to discuss in a bullish market can be applied in bearish market condition. So let's come to our ideal scenario of marking out our dealing range. So as you can see here, price swept sell side liquidity to a higher time frame key level and then expanded away from that key level. So it took buy side liquidity. Now, when this occurs, the point that recently took out the sell side liquidity becomes our dealing range low, and the point that took out the buy side liquidity here becomes our dealing range high. Now, when this occurs, we are anticipating that there will be a retracement into a discount zone of the dealing range in order for price to expand away from that key level. Now, these key levels within the discount area can be high probability order block, an inversion fair value gap, a breakout block, or an internal range liquidity or bullish fair value gap. Now, let's take note of this. After expansion from a high time frame key level, we will be expecting a retracement. Now, the key word here is retracement into a discount or premium array before an expansion towards our draw on liquidity. Now, always take note of current phase of the EBITDA market cycle. So those of us who do not understand the EBITDA market cycle, I made a video on that some weeks back, and I'll share the link at the end screen of this particular video so that you can also go through and equip yourself with the EBITDA market cycle because it is very essential when it comes to choosing the right dealing range because you have to know the current phase of the market and apply them as such. Now, this brings us to our second scenario where identifying the dealing range is quite a bit confusing than the ideal scenario. Now, when price took out sell side liquidity to this higher time frame key level, our daily range low was formed here. And after that, there was an expansion towards a higher time frame key level. Now, when price reached this area, it didn't immediately retrace back into a discount level as we would have expected in our first and then an ideal scenario, but it entered into a phase of consolidation. Now, when we cast our mind back to our EBITDA market cycle, we know that after expansion, there can be an accumulation phase or a consolidation phase. Now, if you consider EBITDA market cycle, what price do not do to reverse after a consolidation. Price do not offer reversals after a consolidation. So in most cases, when you see price moving in a way that looks like a reversal. That particular move is not an actual reversal, but a manipulation to trick inexperienced traders to switch their market bias. So as you can see here, after this consolidation, there was a manipulation. Look at where the manipulation went to, our discount key level before price expanded away from this key level. So let's take note of this because this also occurs a lot in the market. And in such cases, if you are not very careful, you might be trading at the wrong side of the market. Now, let's hop onto the chart and identify some examples of the dealing range we are discussing today. As you can see, this is the 1 hour chart of USD JPY, and we are considering this current month, that is March 2025. And this swing high here was formed on the 3rd of March. So, as you can see, buy side liquidity was raided here. There was a shift in market structure at this point. That's informed us that the market is actually switching from a bullish market into a bearish market. So after this move, you can see that there was lower highs, lower lows, lower highs, and then lower lows that was created in the market, signifying a bearish market trend. So when we swept this buy side liquidity here, this became our dealing range high. So when this dealing range high was formed and price swept this sell side liquidity here, what will come in mind is to pull out your fib tool and then mark out your dealing range high and then dealing range low. So you are expecting that at least after this sell side liquidity was swept here by this bearish move, you were expecting that there will be a retracement into a premium level before price what descends lower. But in this case, that didn't occur. So as you were patiently waiting for price to retrace into the premium level, new lower low was formed in the market. So what do? You move your fib to this swing low, because what we are looking out for is a retracement, the key level retracement, but that hasn't yet occurred because after this expansion lower, price entered into a phase of consolidation, and this is not the retracement we are looking for. So after consolidation, there was another expansion taking out this sell side liquidity here. So what do? We move our fib to that swing point. So this now becomes our new dealing range low, and that's our dealing range high. So what we do here is to wait patiently and anticipate or observe the retracement to occur. That is what we are looking for. Retracement. So when the retracement has not occurred, we are not getting into the market. Like I always say, we are not just looking out to execute trades, but we want to execute trades that have the highest probability of taking us to our draw on liquidity. So as you can see, there was no retracement that occurred at this point. So this is where the actual retracement occurred. And at this premium level, what are the key levels at this premium levels? The first one here that we can identify is this our high probability order block. Our high probability order block. If you want to know more about high probability order blocks, I've also made a video on that, and I'll add that to my end screen so that you also have the chance to go through and equip yourself in that regard. Aside the high probability order block, there is also fair value gap that can be identified in this level. So as you can see, price consolidated for a period of time within this fair value gap before moving away towards our door on liquidity. Now, let me delete these marks and then let's concentrate on the next thing. I don't want the chart to become very messy. That is why I keep deleting these things. Okay, so what you find here is a dealing range inside dealing range. Yes, dealing range inside a dealing range. Now, these things, when you don't train your eyes very well, you will not be able to notice such ranges. Now, as you can see, this swing point here swept this buy side liquidity into our high probability bearish order block and bearish fair value gap over here. So this becomes our daily range high. And look at this point. All this sell side liquidity was also raided by price to this level. Here you can see this is a bullish order block here. Price respected it, and this bullish order block sent price back into premium of this dealing range. So let me say a mini dealing range. But within this premium level, what key level reside in this level for price to come and then react to? That is our inversion fair value gap. There was an inversion fair value gap here that price came back to respect in order to go low. So, like I said, there can be dealing ranges residing within the main dealing range. So, as you can see, this is the current dealing range that we are in. But you can see other forms of dealing ranges forming within the actual dealing range. Now, let's look at this point. And then in all these, the criteria for identifying dealing range must be applied and must be respected. So as you can see, this is the swing high that reacted to our premium inversion fair value gap. So when you mark that as your dealing range high, in this point that took sell side liquidity here, our dealing range low, you realize that there was also retracement into premium level. What premium key level can be found here for price to react to? This our high probability order block once again appears here. So you see this swing high tapped into our high probability order block. Why is it our high probability order block? That is the series of up close candle that was formed prior to the liquidity raid, and then it's left behind what? A fair value gap. So this is a high probability order block, and then price came back to respect that level before coming to take out our actual draw on liquidity here. And let's observe something. After this swing point is what reacted to our premium high probability order block. So look at what's happening here. If we mark that as our dealing range high, and then this swing low or lower low that took out our sell side liquidity here as our dealing range low, you can see that there was a retracement into what? A premium level. Now, after that, retracement, this was the high that swept liquidity into this premium level. So if you mark that as our dealing range high, then we are expecting that this will also become our daily range low since it took out sell side liquidity over here. And when we mark this range, you realize that there was a retracement into a premium level. Now, I am able to identify this because I've been doing this a whole lot of time in the market, and I can see where a dealing range is formed and when it is not. So someone may not consider this a dealing range, but this is an actual dealing range. Why is that? You see, at this premium level here, you might not be able to identify key level here on the 1 hour chart. But so far as price retrace to that level means there is something there worth looking at. So when we can't identify it on the 1 hour chart, we then drop down to our lower time frame and look out for whatever key level within level that price was respecting. So when we go to the 30 minutes chart, this is the point that I was talking about on the 1 hour chart. You can see that there was 30 minutes internal range liquidity residing over here. That price came back to respect. And after that was respected, our draw on liquidity here, our sell side liquidity residing here, price came down to that level to sweep that liquidity. So basically, this is what can provide you for now in identifying the right dealing range and PD arrays to trade from. The channel still remains AK Trades, and always remember to like and subscribe to receive the latest updates from this channel. Good luck and stay safe.